Good morning, everyone. Sorry for that false start there, and welcome to Revenue Accounting for Cloud Computing, part of Tensoft's regular CPE-eligible accounting knowledge series. Tensoft is pleased to sponsor today's event and honored to have the opportunity to work with Jeffrey Werner of Werner Consulting Group again. Just a few housekeeping items. We have a lot of content today, so I'll keep this very brief. We will be issuing CPE certificates within a week of the presentation, so look for those in your email. Be sure to check your junk mail folder. Often these go, because of the attachment and the new sender, these go to junk mail folders, so be sure to check that. For the webcast, you may want to put the screen on full screen. You can do that by going into the corner and tapping the icon for full screen. If you have any questions during the webcast, please send those in via the questions panel, and we will get to those as soon as possible. Jeffrey will be answering those on a regular and frequent basis. Just type those out and send them to us, and we will get to them either during the webcast, or if there is not time, Jeffrey will get to everyone who had questions afterwards. We do have your contact information, so thank you for that. We will be saying a few words about today's sponsor, Tensoft. One of Tensoft's co-founders, Bob Scarborough, will be taking a few minutes to tell you about Tensoft and what we do. And then after that, we'll be introducing today's presenter, Jeffrey Werner, and turn the floor over to him. So again, just a reminder, full screen, go to View, and click on that little icon, and you'll get a full screen to be able to see all of the content. Submit your questions via the Q&A panel. We will be sending out the CPE certificates, and we also will have slides and the webcast recording available on Tensoft's Resource Center at www.tensoft.com. You'll be able to register once and then log in at any time with your password to get the content from today's webcast, any past webcasts, or any future webcasts. So we encourage you to do that. And now I'd like to turn the session over to Bob Scarborough, who is one of Tensoft's co-founders and our CEO. Bob has been in the ERP software industry for almost 25 years and has helped hundreds of software and high-tech companies improve their business processes and lower their operating costs. Bob, over to you. Bob, be sure to unmute your mic.
Thank you. Understood. So welcome, everybody. Thank you for coming today, and we really are pleased to have Jeffrey Werner with us today to cover important topics related to software revenue recognition and GAAP accounting standards and directions related to that. So as background to Tensoft, we'll do a couple slides about us, and then we'll turn it over to Jeffrey. A few things about Tensoft is we are a software solutions provider. So companies that are on the call today that are part of the SaaS industry or cloud software industry or more traditional software industry, we are one of you as well as a provider to you. And we have a software product suite that we call RCM, or Revenue Cycle Management. It does support both the revenue transaction models, so including multi-element arrangements. It also supports a lot of the business process requirements related to various go-to-market models, including things like go-live status, customer acceptance requirements, changing start dates, extension and period of performance, and integration to external systems that really relate to how you view your customers and how you treat them as part of a 360-degree view of success with your customers. Next slide, please. This is a general flow of our application, and we'll start in sort of the middle and go to the right first. And so what we have where it says a sales transaction, or it could be a revenue agreement, is really something that we need to capture the multi-element arrangement, and then when we capture that, it goes into our revenue engine for revenue RCM, and we apply a series of rules to it to get it ready for revenue recognition. One of them is a document workflow. And so we can do things on a document type for the MEA transaction that says this is something subject to the EITF 0801 rules. This is something we can do, something that's result to the SOP 97.2 rules. This is something that has a customer acceptance period. And so there's a workflow associated with the document that comes in and how it should be handled. There's a determined value where we can apply in a multi-element arrangement situation a fair value to the elements on that and a reallocation of the revenue agreement as required for revenue recognition. And finally, we can apply individual rules to the SKUs where we can say this item type, once it has its fair value or its value allocation identified, is recognized on an amortization model, on a usage model, on a percent complete model, on a customer acceptance model. And so you have rules for the documents, the gap compliance or requirement rules for the value determination and revenue rules, all of that pushing out to revenue subledger, revenue reporting, revenue analysis, revenue forecasting. The left-hand side is really the go-to-market model and how the transaction is created in the first place. And so our experience is that revenue, once the multi-element arrangement transaction is identified, revenue processes are remarkably similar between technology companies and software companies. But where software companies are different and unique is really how they go to market. Do they have lots of small transactions, few big transactions, a contractual arrangement, an ERP product shipment through a sales order? And so really what we've done on the other side of the equation is to understand, categorize, optimize for different business process models, and then efficiently capture those transactions and push them into our revenue engine. If we could go to the next slide, please. So I think, again, this just sort of wraps up the information that we've got. We do capture the sales transaction. And I think a lot of people, in terms of experience, find that capturing the right multi-element arrangement up front or as possible is certainly one of the main requirements or something that's definitely an important part of the process. Pushing that into revenue determination, making sure that we comply with the appropriate gap standards, apply things in a consistent rules-based approach, so that the importance of a rules-based approach is really traceability, auditability, and the possibility that your staff or team doesn't have to manually touch every transaction to make sure it's right, because you can be confident that rules are applied consistently. So if we could go to the next slide, please. So I'm really pleased to introduce Jeffrey Werner. And Tensoft is committed to providing revenue recognition and contract management software to our customers. But we really understand that software is only part of the total solution. Another element of managing revenue recognition and contracts is understanding the rules and standards affecting your business. And that's every bit as critical. With that in mind, we work with thought leaders like Jeffrey in this area and look to provide relevant information and resources to our customers and other interested companies. So we're really pleased to have the opportunity to sponsor today's online course session taught by Jeffrey Werner, a revenue recognition expert. Jeffrey is an acknowledged expert in the area of software revenue recognition. He's been providing revenue recognition consulting services to software and technology companies since 2001. Prior to launching his consulting business, Jeffrey was a CFO for Antrim Design Systems, a mixed signal synthesis company in Silicon Valley. Before that, he was VP of Finance for Telepost, a web-based communication services company in Santa Cruz. And early in his career, Jeffrey spent 11 years with KPMG, Silicon Valley office, where he was a senior manager. Jeffrey regularly teaches classes on software revenue recognition in the San Francisco Bay Area. Has over 15 years experience helping companies comply with revenue regulations through policies and best practices. So Jeffrey, pleased to have you, and over to you. Hi, folks. I'm not able to hear Jeffrey yet.
Just a moment.
Okay. Thank you very much, Bob, and welcome everyone to today's webcast. Just another bit of information about the revenue recognition practice that I have in consulting with technology companies. There's a list of a variety of services that I provide and have been providing for the last 11 years to companies in the revenue recognition area. We want to get on to our content for today, but before we do that, we want to mention that in addition to these 1 hour free webcasts that we do a number of times a year, twice a year we do a revenue recognition class, which is a full day class that we take over 2 half-day periods. The next one's coming up in November on Tuesday the 13th and Thursday the 15th. There is a CPE credit for that. It's paid for attendance, and there'll be more details on the Tensoft website soon.
I'm getting some comments about problems hearing you, Jeffrey.
Okay.
Let me see if we can get this one.
Well, apparently we're having a little bit of trouble hearing me. Yeah, hopefully that is better. There we go. Okay. Sorry for the technical difficulties. Again, the software and revenue recognition class will be November 13th and 15th, and registration available soon. This is the agenda for the class. We go through software revenue recognition, the general principles, VSOE, software accounting, and on day 2,
Try this one again.
on day 2, we'll be having services and contract accounting, introducing the relative selling price method of EITF 08-1, talk about cloud computing, similar to the module that we're doing today, the FASB IASB revenue recognition project, and other revenue recognition issues. Here's the outline for today's cloud computing SaaS section. Before we go any farther, I think we need to do a polling question so that we can maintain our CPE credit status and everyone can get that. Hopefully you can hear me now, and we'll be moving on to the content of the webcast now. And I'm getting a thumbs up on the microphone. So the poll is open, and what is our question? Does your company have SaaS or cloud computing offerings? Completed, in progress, thinking about it, or in A? So again, there's no right answer on this. That's just some information about your company and the opportunity to demonstrate that you are in attendance and can receive CPE credit. Caprice will keep the poll open while we start with our outline of today's session. We'll talk about the cloud computing or SaaS business model, how we do cloud computing revenue recognition accounting, answering the primary question, when is it service and when is it software? Talk about setup fees and related costs, consulting, training, and other services that might be offered as part of a SaaS or cloud computing offering, when we have fees based on usage, and what happens in multiple element arrangements that include cloud computing services. Just a history of software as a service. Years ago, the same sort of shared or use of software as a service was called an application service provider, or an ASP. The last 10 years or so, it's been referred to as software as a service, or SaaS, and now you see cloud computing a lot in the media, and cloud computing companies talked about. It's the hot new business model for a lot of reasons, but one is that there's valuation of companies based on the recurring revenue model is very predominant, and you see companies like Workday, who went public last week, using this model, and they're receiving very good results from it, in addition to the fact that it is a very useful way to present software for use for companies and users. When you have a cloud computing or SaaS model, the software is used rather than owned or installed by the user. And the type of cloud services or SaaS services that you see are applications, things like Workday or Salesforce.com. You'll also see platforms which allow those applications to work, and infrastructure companies that provide the servers and the connections for companies to host their SaaS or cloud services for their users, as well as other services that relate to the delivery of the SaaS model. In the SaaS model, this has evolved with the internet. Companies are more interested in use of software rather than owning, and starting 10 years or so ago, Salesforce.com made this a real viable business model and has been extremely successful with it. And lots of other software and service companies have adopted this model. Some of the advantages for software as a service is it's for the customer, it's easy to implement, it's a standard setup, it's ready to go, there's lower upfront costs, you pay as you go over time, and someone else maintains the software for you, so you potentially have lower internal costs, particularly if you're a small, nimble, flexible type of organization. And you don't need to worry about loading licenses on individual computers or updating them. Everything's easy access anywhere over the internet with a browser interface. From a vendor, it can be an easier sale because you've got lower upfront cost of ownership, so it's easier market entry for your customers, results in this predictable, ratable revenue, so this recurring revenue stream that companies like and investors find very useful. It's easy to upgrade and change the features. You don't have to maintain a number of different versions of your software out in the field. You can update it on your servers and your site, and everyone's using one of those upgraders. And then customers get locked into usage. It becomes easy for them to use and hard for them to make the change to another vendor. Some of the potential disadvantages, particularly in the early days, customers had a perception issue with mission-critical resources and the control of a vendor, their data at a vendor, or privacy concerns. And uptime is dependent on the vendor's service level and your internet access availability. From a vendor standpoint, well, you don't get those one-time large hits of revenue when you do software licensing fees and get the revenue recognition up front. And you really have to have a strong customer service focus because you need to keep your customers up and running. We look at how to account for cloud computing and SaaS services. The accounting for this changed over the last couple of years with the introduction of ASU 2009-13, or it's also known as EITF 08-1, introduced the relative selling price method for these non-pure software transactions. It created changes to what is considered a separate element and changed the way that revenue was allocated to the various elements. These changes became required for companies in calendar 2011, so most companies have adopted them, although some private companies are still in the process of doing that. It can be a rather difficult process to transition. The question we really need to ask and answer when we're trying to do the revenue recognition accounting for a cloud computing or a SaaS offering is we need to determine, is it software or is it service? Because the accounting is going to be very different depending on which one of those things it is. Indications that it's software are the customer takes possession of the software. They load it on their server, or they have the right to take it from a hosted environment by the vendor or someone else without significant costs. And that's a key indicator. A lot of times, even if the customer has the opportunity to take possession of it, if there would be significant cost, then we would not necessarily consider it to be a software transaction. The customer has the right and the ability to use it without the vendor because it's hosted on their server. You'll typically see licensing terms with either perpetual or a periodic term license. You'll see things like license fees and support fees. Upgrades are either part of maintenance or an upgrade fee path. The data is going to be at the customer. And through all these things, it may not be exactly clear from the language of the contract whether it's software or services. Sometimes it takes a little detective work, particularly on contracts that were written a number of years ago. What are the indicators that cloud computing SaaS offering is a service? Well, it would be hosted by the vendor. Typically, you would see monthly or usage fees. The data is going to reside at the vendor on the vendor's server. And any end of use or end of contract sort of terms would provide for data transition or conversion rights at the end of the contract. And it's a right to only to use the software over the internet, not a right to own it or take possession of it. And again, the contract may not be clear. Do we have some questions coming in there that we need to take a look at? Okay, so we have a question that says, are there significant differences for companies under IFRS to keep in mind while listening? Well, there are differences between the proposed, well, the IFRS and the proposed IASB, FASB revenue recognition model that's coming up. But typically, you will see under both IFRS and US GAAP that you'll be using the relative selling price methodology that we're going to talk about shortly. So that is a real good question because that is on a lot of people's minds. Companies that are using IFRS that are subsidiaries of companies from other countries that follow IFRS, or companies that are looking to be aware of what the differences might be when and if IFRS is adopted here in the United States. To do the revenue recognition accounting, we still need to follow the 4 general principles of revenue recognition. So we have to have evidence of an arrangement. We have to have delivery occurred or be performing the services. The fee needs to be fixed and determinable. We need to know how much we're going to account for from the transaction, and collectability needs to be probable. We're not going to go into those in depth, but we do want to remind you that we still need to meet those 4 criteria. And just as a mnemonic device, if you're trying to remember all 4 of them, it's not ABC, it's C, D, E, F, where the C is the collectability, the D is delivery, the E is the evidence of the arrangement, and the F is the fixed and determinable fee. That's a whole half-day or quarter-day session in our lengthy class discussing the various aspects of these general principles. When we're going to account for a transaction, there's 3 steps that we need to do the revenue recognition. Our first step is to separate out a transaction into its various elements or components. We'll talk about that in detail in a moment. Then we're going to allocate the revenue to those elements, and then finally recognize the revenue for each one of the elements as that element is delivered or the performance of a service takes place. Now, we follow these steps regardless of whether it's a software or a cloud computing type solution, but the steps that we follow in those transactions are very different depending on what sort of transaction we have. So elements or obligations of an arrangement, these are the elements. You're typically going to see them named specifically in the contract. They're going to require some kind of overt, distinct action on the part of the vendor, either delivery or performance of some type. And typically, the transaction price would vary if this item that you're trying to determine if it's a separate element were included or not included, or the lack of the performance of it would change the price of the arrangement, either reduce the price if it wasn't included, increase the price if it is, or result in some sort of penalty or reduction of the price if the service was not completed in a timely manner. think we're coming up on time for another polling question. And what is our question? Does your company have a separate independent revenue and billing processes? Yes, no, don't know, or NA. And while we're looking at that, are there any other questions that we need to? Nope, nothing else comes in. So I do invite you, if you've got questions during the course of the webcast, to use that Q&A function, and we'll try and answer them while we're on the topic, or we'll leave some time hopefully at the end to cover that. For our elements to be separate, they need to be individual, they need to be independent. Either they need to be functionally independent, contractually independent, and no rights or return related to them relative to other items in the transaction. Individual items need to have standalone value, and they have standalone value if they're sold separately either by the vendor or by another vendor, or if they have resale value. Now, typically with services, you don't meet that resale value type criteria. The important thing is, to be an individual element and to account for it separately, it needs to meet these standalone criteria. If it doesn't meet that standalone criteria, then we're going to treat that element along with other elements potentially as one unit of accounting. Now that we've allocated, or we've separated our transaction out into the various elements, we're going to allocate the revenue to those various elements. And here's where we have a big difference between our software revenue recognition, which uses the residual method, and our service revenue, which uses the relative selling price method that was introduced by EITF 08-1. In the residual method, which is used by software companies, we defer the full value of any undelivered elements using VSOE, vendor-specific element objective evidence. And then whatever is left, that value, the residual value, is allocated to the delivered elements. Our topic today really is accounting for cloud computing and SaaS transactions, so we're going to focus on the relative selling price method. This is what changed with 08-1 a year or so ago. And now we're going to allocate revenue to each element based on its relative value. And to get the relative value, we look at one of the value methodologies that we have for each element, either VSOE if we have it, TPE, which is third-party evidence, or estimated selling price. And we use those to add up and determine what the total value of the transaction is, and then take each element's percentage of that total value and multiply that times the revenue for the whole transaction to get the amount of revenue that's allocated to each element. Then we recognize the revenue for the elements as we deliver them. So in a SaaS or cloud computing type of arrangement, we might have a variety of things that are offered to the customer that could be potentially separate elements in the transaction. So we'd have subscription fees, which is the ongoing monthly or annual fee that the customer pays to access the software. There may be setup fees to get the software installed and configured so that the customer can use it. There may be other implementation fees or services that relate to how to use it within the company. There might be data migration or content migration to populate the SaaS service. There may be other consulting services, training services, business process type services, even project management. And then sometimes the fee structure for the arrangements is based on a usage fee rather than just a time or subscription fee. So these are potentially the elements that we would have in a cloud computing or SaaS arrangement that we would need to determine whether they had standalone value, whether they were separate elements, and could be allocated revenue individually, or should be looked at as either one element for the whole transaction or several groups of elements for the transaction. Really the question we need to ask when we're doing this element separation is there standalone value? And oftentimes in SaaS arrangements, you do not have standalone value. This would be situations where the vendor doesn't sell that service or that option separately, and no other vendor offers it. When 08-1 came out, a lot of SaaS companies that previously did not offer some of their services separately found that those services were offered by another vendor and therefore now had standalone value, even though the vendor didn't necessarily sell those services separately to have standalone value internally. But we need to determine whether they have standalone value. One that we see a lot of issues with is upfront services that are required or necessary to get a customer ready to use the subscription. And if they're necessary and inseparable from using or obtaining the services, then they're probably not going to be considered to have standalone value and are going to be considered to be one element along with the ongoing subscription or services fee. Typically, the upfront services have little or no value without the ongoing service. So no customer would buy the setup services if they weren't also buying paying for the subscription and using it over time. And typically, you'll find that the upfront services or the setup and installation is not a service that's offered by other vendors in order to give it standalone value. So if it doesn't meet this criteria, then we would not have standalone value for those upfront services, and we would typically recognize them as one element along with the subscription services. Now, applying the relative selling price method to SaaS and cloud computing solutions and services is a rather new area. And currently I've found in my practice that there really isn't a consensus on how to do the accounting for the setup fees. There seems to be two schools of thought about how companies should account for those setup fees. One of those schools of thought says that there's no standalone value for these setup fees, so you should treat them as one unit of accounting with the subscription services over the contract period. And this is consistent with the language of 08-1 that says if items are not considered to have standalone value, then you treat them as one unit of accounting. Now, some other companies and auditors have taken the position that when you set up a customer for a SaaS or cloud computing service, you're creating an asset for that specific customer that has value over a period of time. And if that period of time is longer than the contract period, then you should allocate that revenue and recognize it over that longer period. I think technically there's an issue there, because if you don't have standalone value, how do you know how much revenue to allocate to those setup fees? So I don't consider that to be the best way to do the accounting for these setup services and fees, but some companies have taken that position and are doing that. So you may find that your company does one of these two methods and you need to apply it consistently. Now, there is consensus on what to do with the costs of these upfront services and upfront fees to get a customer set up and able to use the SaaS or cloud computing service. There's a optional accounting. You can either expense those costs as you incur, or you can defer them and charge them to expense proportionally over the same period as the related revenue. And this is the accounting option of the vendor as long as it's applied consistently. If we have usage fees, we're going to recognize the revenue for those usage fees as the usage occurs. So it'll be monthly. Maybe you have monthly fees with an additional usage fees, which is very similar to your cell phone bill, where you get a set number of minutes on a monthly basis, and if you go over that amount, then the cell phone provider bills you for that overage, and you don't get really the opportunity to roll those unused minutes over into the next period. So same thing in a SaaS sort of arrangement. You would use, you get your monthly billing, and if you went over your usage fee that was, level of data usage or a number of users, or sometimes it's a number of instances that you access the SaaS service. There's a lot of different ways that usage can be billed. But from a vendor's perspective, if you have usage fees, typically you're going to recognize that usage as revenue as it occurs. And are we ready for another polling question? Okay, so our question, does your company have usage-based fees? Very good timing, Caprice. Yes, no, or in A. And do we have any other questions that we should take a look at? Let's see. Would services, consulting and data migration really be considered to be sold separately if a subscription or usage is always part of the deal? Well, I think that's a good question. A lot of companies grapple with this issue because oftentimes you'll find that a company will set up a customer, and leaving the setup fees aside because we have talked about those, but data migration, content creation, those other kinds of services that are associated with the SaaS or cloud computing services may or may not be considered to have standalone value and be able to be recognized as separate elements depending on the facts and circumstances. For example, training is one that you often see, and vendors often offer training as a separate service that maybe customers don't purchase in their initial setup and usage of the service, but maybe purchase that training service later. I think if the service training is sold separately, either by the company or by another company, potentially would meet the criteria for being a standalone element, even though it is used in the context of the service. So same thing with data migration. Sometimes a company will purchase a SaaS or cloud computing service and add a small amount of their data or content to that service, and then over time engage the vendor to add additional content, either back content or new content. And if that's the case, I think you have a situation where you could take the position that those data migration and those data content services are standalone services that can be recognized separately. One way some companies take a look at this is they say, is it absolutely necessary for this service for the customer to use the SaaS or cloud computing solution, or is it something that enhances it? So is it required, or does it make it more better? And if it makes it enhanced usage or makes it more better, then I think you've got the potential that it could be considered to be a standalone element that could be recognized separately. And really, if another vendor offers that service, I think clearly in that case it would be considered to have standalone value. So you could recognize these data migration services potentially, or training or consulting that wasn't absolutely essential to the use of the service, could be recognized as they're provided rather than ratably over the service contract period. And this is one of the things with when 08-1 came in with this standalone value an analysis to determine if things were a separate element. Things that were not considered separate elements before became separate elements and had their revenue recognition triggered on a different basis and recognized over different periods rather than everything going ratably over the contract period. Any other questions come in? Got one more? Well, if we take it a little, we do need to move on. So let's take an example of how we apply the relative selling price method to a transaction. So in this case, we've got a $12,000 subscription fee for the monthly service, $1,000 a month. And it's renewable in year 2 for that amount. We've got consulting, in this case 5 days, at $2,000 a day or $10,000. So we've got a $22,000 transaction. If we consider that the consulting has separate value, then we could recognize that as it's provided. If we didn't, then we'd look at the whole $22,000 as one transaction that we took ratably over the 12 months. In this case, If both of the items were at their VSOE, there wouldn't really need to be any allocation that's different from the contract period. So we'd recognize $1,000 a month for the service fee based on its VSOE or ESP. In this case, it's renewal fee. And the consulting we'd recognize when we completed it. Let's look at that same example when we discount one of the elements. In this case, if we discount the consulting, and I apologize for the slides got a little out of format here when we put them up today, but if we had $12,000 for the monthly service fee over the 1-year period and $8,000 instead of $10,000 for the consulting, we have a $20,000 total transaction fee. And we're going to account for that based on each of the items' relative value. We'd look at the relative value of the subscription is $12,000. The relative value of the consulting is $10,000. So there's $22,000 of value in this deal that we're selling for $20,000. So we calculate the percentages of each one of those items. It's 55% for the subscription and 45% for the consulting. In this case, then we'd recognize the subscription revenue at $11,000 and the consulting revenue at $9,000. So we'd have a total of $20,000. And then we'd recognize both of those items as they're delivered. So if we completed the consulting in month 1 or 2, we could recognize that and recognize the subscription over the subscription period. This is obviously a simplified example, and we do have a consideration that we don't take into in the example here, is that you have to also be aware that if you have contingent revenue, if you were only going to get paid for that subscription, for example, on a monthly basis, then maybe you'd have to allocate the full amount to that. But contingent revenue is a whole other topic that we really don't have time for in the 1-hour webcast that we've got today. But that's definitely something that you need to take into consideration when you're applying the relative selling price method. Another consideration that we have is a lot of companies that are offering cloud type solutions or SaaS services are traditional software companies that are migrating their business model from a perpetual licensing model to a cloud computing or SaaS type of arrangement. And when we do have software that's sold in combination with products or SaaS services, cloud computing, we're not going to be following the software revenue recognition accounting that we did previously. If we've got a SaaS or service offering that's not related to a pure software transaction and a software license, we're going to follow the same methodology that we just talked about with regards to the relative selling price method. We're going to separate the transaction out into its various elements. We're going to allocate the revenue to those elements based on the relative selling price, and then we're going to recognize them based on the type of element that they are. So it's a little more complicated situation, but it does come into play because a lot of software companies still have their traditional perpetual or term licensing model and may offer the exact same type of software as a cloud computing or a SaaS solution and may sell multiple element transactions that have both software and cloud computing or SaaS services in them. So we're going to take a look at how we do the accounting for that with an example. So here we've got a software company that enters into an arrangement with a customer. They're providing software license A, so it's a perpetual software license, so it's a software accounting. Support on that license. Also a 1-year SaaS service for product B, or a different type of element, and some other services. Now prior to 08-1, this would have all potentially been considered a software arrangement, which all the elements would need to have VSOE if they weren't delivered up front, and we'd be applying the residual method. But now we don't do that. Now we're going to follow the relative selling price method for doing the revenue recognition, allocation, and recognition. So in our example here, license A, the perpetual license, is $100,000. The support on that is $20,000, which is, in this example, we're going to say that's VSOE. It's 20% of the net license fee. There's also a $50,000 subscription fee for a SaaS service and some other services that are going to be provided. And in this example, we're going to say those services have standalone value. They aren't necessary to use the SaaS service. They're independent from that. We've got a total of $200,000 in this contractual arrangement with the customer, and now we need to allocate the revenue to those various elements. So we've identified 4 elements in the arrangement. Now we'll use the relative selling price method to allocate the revenue to them. And we look at what are the values of each one of these elements. And here it's easy because it's a theoretical example and I can just tell you what they are, but if you're a company that does transactions, you know that coming up with the ESP value of a license, for example, or VSOE for a service can be a very complex and elaborate process that requires a lot of effort. But in this example, we just have it given that our ESP for our license is $130,000. Our support is VSOE at $20,000. Our SaaS service, if sold alone, would probably be $60,000, or maybe that's the renewal price that we use. And the services would be $40,000 based on VSOE. But there's a $50,000 discount in the transaction because they purchased all 4 of these elements. So we look at what the relative value of each one of these elements are. So the software license, when we do the math, is 52%. The support is 8%. The SaaS service is 24%, and the services are 16%. Hopefully that added up to 100%, and we'll use those percentages to allocate the revenue to the various elements. When we do that, the total of $200,000 comes out: $104,000 for the license, $16,000 for the support, $48,000 for the SaaS service, and $32,000 for the other consulting services that are provided. Then we have to look at how we recognize those, because the license and the support are going to be recognized under software revenue recognition rules. We used the relative selling price method to get the value that's associated with those. But now we've got $120,000 of license and support that's going to be recognized using software revenue recognition, and the $48,000 for the SaaS service and the $32,000 for the services that are going to be recognized using 08-1 revenue recognition. So here in this example, the $120,000, the total for the software, we're going to have to use VSOE for the support and defer that. And even though we had a relative allocation of $104,000 to the license, we have to follow the residual method here when we do the revenue recognition for these 2 software elements. So we defer the full value of the support and recognize the $100,000 for the license on delivery. That's the software elements of this multiple element arrangement. The non-software elements, the SaaS service and the service, we'd recognize those as they're provided. So the SaaS or cloud computing service, we'd recognize that on a monthly basis, 1/12 over the 1-year period. And the services we'd recognize as they were completed, either on a daily basis or if there were some kind of acceptance period, or if it was potentially a fixed fee type of arrangement, we recognize those when the services were completed. So we'd recognize those differently, but we would still recognize a total of $200,000. And you see how we apply the relative selling price method to this transaction to recognize the revenue, separating out the elements, allocating the revenue, and then finally recognizing the revenue based on the type of revenue that it is and the method or period of delivery. So we have one more polling question to do, and we're coming up to the end of the webcast today, so we will see if there's any other questions. But our polling question is, does your company have usage-based fees? We did that one already. So we need a different one. And then I'll look at the questions. Okay, so what method does your company use to establish ESP for services? Do you use a cost plus margin methodology? Do you use some kind of ESP study similar to what you do for VSOE but not be as stringent on your parameters? A standard list price, less discount, or some other methodology? Or is it NA because your company doesn't have ESP? Because you either got VSOE or you're a software company, you don't need to do it, or perhaps maybe you don't have multiple element arrangements. So those would all be reasons why you wouldn't need ESP. But if you do have it, what's the methodology that you use it? And let's see. What are our questions here? Okay. Okay, well, I think we addressed, don't we find that most SaaS companies cannot separate out integration and professional services from the SaaS service. And as he indicated, really that's going to be a facts and circumstances thing. If you sell them separately on a standalone basis as a follow-on sale, you may find that they do have standalone value and can be accounted for separately. Clearly, if that same exact service is offered by another vendor, it would meet the criteria for standalone value and could be recognized separately. I guess one thing you'd have to consider would be whether, even if it had standalone value, if there was some ongoing obligation to that service that you provided to make sure the result of it was compatible with the SaaS service for the remainder of the time that the customer had the service, then perhaps it would be tied contractually to the SaaS service and wouldn't meet the standalone criteria then. But I do see a lot of companies that previously took the professional services or implementation type services ratably over the SaaS or cloud computing period are recognizing those independently now because they do feel that they meet the standalone criteria. For consulting services, VSOE has been established in the past. Can those be separated? Well, I think by definition, if you have VSOE for an item, that's because you sell it separately. So that would certainly be a strong indicator that you have standalone value for that item. And yes, if you're establishing VSOE or ESP ranges are a good methodology for doing that, particularly if you don't meet the stringent requirements for VSOE. You can use expanded ranges, I think, for ESP. For example, if your VSOE standard is plus or minus 10 or 15% from an 80 or 85% grouping of elements, perhaps you could use 25% plus or minus and 50 or 60% of the items to qualify for ESP. Because remember, when you're using the relative selling price method, you are required to come up with ESP for an element. It's not an option. You have to have a value, so you need to use your best estimates. How do you see companies communicate the revenue impacts when switching from a traditional software perpetual model to a SaaS? Well, you're going to see, obviously, that the revenue is going to be on a more ratable or ongoing basis rather than at a point in time. So I think a number of ways companies do that. Sometimes they migrate slowly, where they continue to offer their perpetual models and add a SaaS model, and then as customers migrate from the perpetual to the SaaS model, they migrate the company to a completely different revenue recognition model over time. If you're doing it all at once, I think the question is a really good one, because there's a significant effort involved to explain or to educate your customers, your shareholders, your analysts, your business press as to what the difference is in your your revenue. What was actually a change in your business, and what's a change in the way you do the accounting. So it's a significant item. I want to get through a couple more slides here before we run out of time, and then we'll go to questions at the end. I think we've got all our polling questions in, so if you've answered those, you should be good for your CPE. Let's see what else is on our schedule. So just kind of a recap of what we talked about here on the cloud computing and SaaS revenue recognition. Really need to ask and answer the question, is it a SaaS or cloud computing? Is it a service or is it software? Because the accounting is going to be very different depending on the answer to that question. We're going to use the residual method if it's software and need VSOE. If it's a service, we've got a lot more flexibility, but we're also going to have values for each element, and we're going to need to determine whether we have standalone value for multiple elements. If we do have multiple elements, we're going to use the relative selling price method to allocate revenue to those various elements. We talked about multiple element arrangements, looked at some of the issues regarding setup fees and the related setup fee costs, how we account for those. Talked about consulting and training services, when we might be considered standalone or separate elements that get independent revenue recognition, when they might be considered one element with the service. We talked about usage fees. And finally, the situation where a software company has both SaaS and perpetual offerings, how you would account for those in a multiple element arrangement. So we're almost out of time today, but as you can tell, it's an interesting and complex topic, and revenue recognition always has a lot of complexity to it. So if you're interested in these topics, we've got, as we said, an expanded revenue recognition class coming up in November. It's 2 parts, so really it's a one-day class that takes place over 2 mornings and early afternoons from 9 a.m. to 12:30 p.m. This is Pacific time. I think in November we're off of daylight time by then, but it'll be from 9 a.m. to 12:30. And part 1 will be Tuesday, November the 13th. Part 2 will be Thursday, November the 15th. There's CPE credit for it. It's paper attendance, and you can look for registration details for that soon. The content of the class is going in depth into the general principles of revenue recognition, talking about multiple element arrangements, looking at VSOE and software revenue recognition accounting, then services and contract accounting, both in the context of software arrangements and other service or product type arrangements. On day 2, we'll review our general principles and other information that we discussed on day 1. We'll finish services and contract accounting to the extent we didn't do that on day 1. We'll look at the relative selling price method in depth, so how to apply 08-1. We'll look at cloud computing and SaaS arrangements similar to some of the items that we talked on this abbreviated webcast today. So if you're looking for more information, that would be a good place to get it. We'll also talk about the upcoming FASB ISB revenue recognition project, the status on that, and when that might become effective in the United States. Then we'll talk about a host of other revenue recognition issues to the extent that we have time. That's our agenda for the November 2-part webcast. If you've got any questions or comments on the content today on our SaaS and cloud computing webcast, you're welcome to email me. My email address is there, wernerj@sbcglobal.net. And let's see if we've got any other questions that we can answer here while people are still on the webcast. Well, we'll take a couple here. How do most companies determine ESP for a SaaS subscription fee? I think one way is if you have renewal language in your contracts that says you sell the service for $12,000 this year. If it's used at the same level, same number of users, etc., it'll be $12,000 in year 2. That would be a good indication of that. I know that companies have a hard time applying a cost plus margin for a SaaS offering because you don't really have incremental, distinct individual costs for each customer because you use shared instances of servers to serve them. And typically your SaaS fee arrangements are going to vary depending on the customer and the arrangements of the deal. So I think renewal rates are typically a good way that companies do that. Although if you have standardized pricing and standardized discounts, maybe you can take that ESP or a discount approach to establish ESP for subscription fees. And how do you determine if a cost should be expensed as incurred or deferred? Well, the only cost that really would, I think, be deferred is those setup type costs. And the criteria is that it needs to be direct and incremental to that transaction. So if, for example, you had consultants that went to the customer and worked for 3 days, the cost of providing those consultants for those 3 days would be, direct, distinct, and incremental costs, so you could capitalize those costs and take them ratably. We've got a couple other questions, but let's see if I can just answer them now. If software is offered as SaaS on a subscription basis, would we be able to establish VSOEs? We can demonstrate that the renewal description is sold on a standalone basis, and by that use a VSE to allocate the revenue to the elements rather than ESP. I think you would. It's really going to depend on your auditor's relationship, how many transactions they think you need to have, whether they consider your standalone sales to be substantive, whether you have a business practice of following those renewal rates. I think it would be very similar to what companies experience with using support renewal rates to establish VSOE for support. How do you account for it if the company doesn't have VSOE? Well, you could establish ESP somehow, but again, if you're using the relative selling price method, because you do have multiple elements in the arrangement that have standalone value, you are going to have to come up with some value. So you're going to need to estimate that based on some consistent, reasonable methodology. You can't punt. You can't take a residual approach to it. So you do need to come up with ESP for those SaaS service offerings, and it can be quite a challenge to cloud computing companies because they do have a variety of pricing models for potentially the same service that's offered to two different companies. So could the development for the implementation be recognized when delivered, or would it have to be deferred? Well, again, that's an option for the incremental direct cost to do the implementation for the company, and just that would be an election that the company would make depending on their preference and their business model. Some companies find that they really have a great difficulty collecting those individual costs, so they've found it simpler to just expense everything as they go. Other companies have pretty rigorous project accounting, so they can keep track of those costs and want to try to better match the revenues and the expenses such that they don't have fluctuations in their operating margins based on how they did the expensing. Jeffrey, how do your clients typically determine ESP, cost plus margin or VSOE light? Well, it really depends. Companies that have products with tangible items often use the cost plus margin. Most other type of arrangements, I find like a VSOE light type approach is the one that works best. Some companies have really consistent pricing, particularly if they use a channel or distribution model where each distributor has a set price and they don't negotiate each transaction, so maybe that distributor's price list can be the ESP that is rarely deviated from. So it really depends on the facts and circumstances of the customer, of the vendor and how they sell to their customers. So I think that's going to wrap it up for today. Thanks very much for joining us. We will have some more webcasts coming up in the future. You're on our mailing list from being here, so you'll get notice of those. And again, don't forget about our two-day class, November 13th and 15th, coming up next month. Thanks for joining us today.